Good evening and welcome to World Investor Week 2021, organized by the Center for Capital Markets and Risk Management at IIM Bangalore in association with the National Stock Exchange of India. Our speaker for this evening is Mr. Badri Narayanan. Mr. Badri Narayanan is an active investor in the Indian markets and invests based on his proprietary earnings algorithm. He is a qualified chartered accountant with 25 plus years of extensive career experience in the domains of investment management, private equity, turnarounds, and investment banking. Notably, he was a former partner at Ernst & Young and a former member of the Financial Sector Legislative Reforms Commission of the Government of India. He is the founder and CEO at Equity Levers, a specially designed finance lab for budding investors and finance enthusiasts. Today, Mr. Badri speaks about how to pick winners from quarterly result announcements. Growth is the most important driver of stock performance. Through live examples from the current quarter results, Badri will highlight the key financial and valuation metrics to look for in quarterly result announcements to pick winners. He will also explain how historic valuation, multiples, and growth ratios can be used to identify value opportunities. Thank you for accepting our invitation, sir. The presentation will be of 1 hour duration followed by a Q&A sessions. You can post your Q&A questions on the chat window. Thank you.
Thank you, Anvesha. Thank you everyone for joining this webinar. Today we'll be talking about result announcements in fair amount of detail. The idea of this this webinar is to develop a data pattern approach to investing, and the concept is very similar to watching charting. Here we'll look at financial data to form informed view about a particular stock. So let's go there. So the agenda will cover how to read quarterly results to spot real growth. And there is a difference between real growth and quarter, QOQ or YOY growth. We will demonstrate that through live examples. How to use historic valuation multiples to spot investment opportunities. So when you look at various websites, they give you valuation multiple as of today. But as of every result date in the past, there is a valuation multiple which was there. And if you read it as a pattern, what was the PE, what was the price to sales, what was the PEG earlier, it gives a story. And we will be looking at that to help us spot attractive investment opportunities. How to use historic market capitalization data to find scale. Now, typically most websites will give you a share price information. The share price information should be read along with the valuation of the company. The valuation of the company is the market price into the then number of shares. So a market capitalization kind of gives you the scale that is possible for a company. So you look at a few situations where you could have identified a company, even though its PE may be 100 times. It has a great scale opportunity, and it's a very important pillar of finding very good attractive opportunities. Now, combining all this, we will look at the common data pattern, which is common for all winner stocks, all multi-bagger kind of stocks. What is the common data pattern? If you want to, if the same data pattern will reveal when to hold or when to sell by looking at the reverse pattern of what we have discussed. Then we come to how will we find a good attractive industry to dive deep. Then we come to how to get the story, how to justify the numbers. What is the story, what is changing. So we'll come to that. How do you go about doing that? And finally, how Equity Levers Finance Lab is designed to help budding investors learn about markets much more easily. So let's get started. So one of the key things is that change in growth Growth itself is not important. Change in growth is most important driver. Now, what are we saying? If a company is growing at 20% and we are getting evidence that it is going to grow at 24%, so 20% more, then there is some meaningful story. So if a company is growing at 20% and suddenly it starts reporting 15% growth, then there is a problem. So those are companies where the price will adjust downwards. Normally, that's how this thing works. So as a corollary, what are we saying? We are saying that all company competitor policy, market liquidity information is already in the price. So when you say that Maruti is around 7,500 rupees, all that it is doing is reflected in that 7,500 rupees price, plus plus the market capitalization of the company reflects the valuation basis all of that which is already available. By learning a lot more about the company, you will not discover the winner or losers. What will need to be understood is what is changing or what is expected to change over the next 3, 12 or 15 or maybe over the next 5 years. So for example, if you take Maruti, a lot is changing, a lot is happening in terms of electric vehicles, new companies, new kind of innovations are coming, and Maruti will be judged with reference to where the opportunity is going to lie. It is not going to be based on what brands it has, what is the sales it has been doing for the last 10 years. So clearly the change in growth and the reasons for the change in growth is very important. By finding what is changing for a company, you can estimate the expected price change. So let's understand this a little better. So for Maruti today, the situation is that will CNG cars pick up? Will EV cars pick up? What are the brands that are going to win in the future? What is the government policy going to be for the products of Maruti? These are things which will get announced, and slowly they get reflected in the data shown by the company. So watching the change is very, very critical. So how do we do this? How do we observe? Just like a technical chart, can we make financial data also speak to us? Can you make the financial data speak to us? Which is exactly what we have tried to do in Equity Levers Finance Lab. So there are two new information which you will find in this lab, which is the valuation ratio of a company on every result date, historic result date, and also the market capitalization of the company and each of the result dates. Now, when you put these two numbers alongside the data, what really happens is it starts to tell you what the company has a resume. So in 2017, the company did, this is Asahi Glass, the company did a sales of 2,500 crores. And at that time, the market cap of the company was 9,371 crores. And the valuation multiple was 60 times. Now, subsequently, with every change, you immediately get a barometer check on the PE multiple and the market cap. Combining these information, you're able to read a person's resume, a company's resume for the markets. So we've highlighted the quadrant date on which this result has been put out, the market capitalization, the net profit data, the sales data, the growth, and the valuation data, of course the ROE. So we are going to use this extensively in today's discussion, where we will be talking more than about 15-20 companies, using these parameters to be able to read out the resume and also seeing what is likely to change. Now let's go forward. So the other set of data, in addition to the P&L data, is the balance sheet information. That is also presented on a quarter-on-quarter basis, with the market cap and the cash flow from operation as a bedrock for each of the data points. They kind of give you a corroboration of what is happening. So this is the balance sheet information which we will be using. So let's get the basics sorted. What are we looking for? We're looking for conventional DCF valuation. It means that whatever is going to grow faster will have a better value. Basically, discounted cash flow, you discount a future set of cash flows at a discount rate. So if your growth is going to be better, the DCF value will obviously be more. So in abstract sense, what are we saying? We are saying that, can we say if a company is growing at 20%, can we visualize, is it going to grow faster at 25%? Is there clear evidence of that? Can we, because of this, can we see that the ROE of the company will, return on equity of the company will go up? So we are basically, it's incremental change from the resume. The resume is the chart which is there, which is visible in front of you. And we are saying that, is it faster? Is there a faster growth, or is it a flat growth, or is it a slower growth? There are two things we have discussed, PAT and ROE. And then the third one, which is very important from a hygiene standpoint, is if the PAT is 100 crores, then is the cash flow somewhat similar to it, or is it likely to be somewhat similar to it? If the cash flow is not there, then incremental growth and expectation in ROE will not make a sense. So these are the three pillars which drive the market to upward adjust or downward adjust its price and the market valuation. Now, what is attractive valuation? Now, attractive valuation, is different for every type of a company. A fast-growing company, a loss-making company, so many different types of companies exist, and for each, the market has a different set of valuation. So if you have historic valuation data, which is the PE ratio, the price to book ratio, the EV/EBITDA ratio, the PEG ratio, price to sales, and so on, and for every result date, historically, every time the result was announced, the new calculations are done. And if you are able to put it in a range and watch that, it'll kind of tell you what range it is. So for a particular growth, for a particular ROE, the market gave a certain valuation. If we are still in the same historic range, but we can visualize an incremental PAT growth or an ROE, then that share will actually start to rise. And similarly, if in the same price, if the incremental growth is negative and the expected ROE is negative, and the outlook for that, it becomes negative, the PE and the valuations will fall, and so also the market capitalization. We will see that this whole thing play out step by step. Right. So now let me connect this with what analysts typically do. It has been shown, or rather surveys have been conducted among analysts and investors. 90-95% of the world uses a forward EPS into a forward PE multiple approach to do this. It's a much better way of doing it, because running a DCF into next 30-40 years is very difficult. Nobody can know that. Immediate 3-4 years brings maximum value to the DCF. So what is the forward EPS and forward PE? Typically 1 to 3 year forward. Most analysts who want to be charitable give a 3-year forward EPS and forward PE multiple. Best winners actually come when you can visualize a rapid growth in the next 12 months. If it is going to be massive, then the share price appreciation will be very, very strong. So this approach, how does this work? Now, here is a brief template. This is as of September 20. Now, this is a company where, if you see, the company's cash flow has been flat. The quarterly earnings per share, 45, 44 is flat. And somewhere in the December 19, it starts to climb from 50, 60, 80, 100. Now, we've just done a 4-quarter, addition to reflect 162. And suddenly after December 19, it starts to climb to 290. Now, the EPS growth on a QOQ basis is around 25%. EPS growth on a YOY basis is 42 and 80%. We've made the calculation. Let's assume that the PE ratio on these dates, and these were prevailing in the last year or coming out of COVID, was 30 times, 25 times, and so on. Now, the market price of, let's say, was 8,700. On June 20, it was 5,750. And March, it was 2,850. Now, does this company have a potential? Very clearly, we can assume, based on this growth, without even knowing about the company, and we'll do that subsequently. Let's assume a 30-35% growth for the next 2 years, September 21 and 22. Basis that, we calculate that the annualized EPS will, from 290, will move up to 508. Now this translates into a forward PE, which is 30, comes down because of this earnings. Forward PE using current market price comes down to 17 times. Now, if I were to assign at 25 times PE, which was 1 quarter back at that time, then I get an expected price of 724 in as of this September 22 number. Now, there is an upside of 4,000 rupees, right? So this is a classic data pattern which we are looking for, where there is an acceleration in the earnings. And if you just make these kinds of simple calculation using the historic numbers, you will get a strong upside. Now, there is one more angle which we will establish as we go into the companies in detail, which is what is justifying, what is happening, why it is contributing. Now, let's look at another company. Now, here is a company where the company is doing the same EPS for last 8-9 quarters. There is a QOQ increase of 37%, but YOY is meager. PE ratio has climbed from 7, 8, 10. So if you assume a 5% growth, the forward PE is in the same range. It doesn't give you any extra growth from the numbers. So if you see that there is a downside because the PE ratio has already moved up, and if you were to give a 8 times forward multiple, then there is a downside to this stock. So this kind of stock data pattern we don't want to pursue. What we want to pursue is a rapid increase, which is available. Now let's move forward. So we humans love data patterns. So a large part of investor community looks at charts, whether it is 200-day DMA and 50-day DMA and so on. Similarly, financial data read along with the market cap data on each result date is a chart in itself, and which is exactly what I'm trying to talk about in this particular session. So we will, using this chart approach, we will look at what is real growth, what is attractive valuation, what is attractive scale. This is reference to every company. Every company is unique and will have to be assessed basis that. So let's move forward. So how to read quarterly results to spot real growth? Now, just QOQ and YOY rates of growth are not enough to find real growth, and we'll demonstrate that. Strong beat is rare. You know, if there is a strong beat, it is rare and could mean the scale of operations is changing, and this accordingly the price will adjust. We will demonstrate that. We have to consider the base effect, like last year was a COVID year, so the growth may not be correct. So we'll do this with these 5 companies: Jubilant Food, which reported results on October 20, Hindustan Unilever, Nahar Spinning, Asahi Glass, Sport King. So we will take 5 companies one by one into this. Now let's move to the browser. So this is the data for from our website for Jubilant Food. Now, if you see the sales data for the last 4 quarters, it is just 1 minute. Okay. So before we go forward, this is the consolidated data reported by Jubilant Food, which is the first company we are going to see. Now, this company, if you see, there is a quarterly YOY growth of 36% in revenue. EBITDA is 33%. PBT and PAT is 58%. Now, this is misleading. And how is it misleading? So if you look at the data here, the last 4 quarters, if you look at it, 2021 sales data. Okay, let me explain the chart first. This is the quarterly information. This is the trailing 12 months information. So this sums the last 4 quarters, available quarters, to create a balance sheet as of that date. So this is the market capitalization data. This is the quarter end, which is there. This is the share price on those quarter end dates when the results were announced. This is the sales data. This is EBITDA. This is net worth. This is the sales growth, EBITDA margin, PAT growth, PAT margin, ROE. These are the 5 valuations on each of the result dates. They all will tell you a very good story. So we saw that the company's YOY growth was good, and that is because last year was base was low, so it reported a very good. It looks optically very good growth. But if you look at all the 4-5 data points, the sales has been in the same range. There is no beat. The PAT there is no beat. There is, if you look at the EBITDA, there is absolutely no beat. It's not even, convincingly, it's not beating. So a company which is trading at 117 times PE should be at least showing, a consistent, the 4 quarters, if you read, it should be able to visualize at least a 20-30% growth, but it is not visible. So, which is why if you see the share price, if you see the share price over the last 3 months, it has been flat and actually has fallen over the period. Okay. So now let's take one more company. Next company is Hindustan Unilever. Okay, here we have a stronger growth, but it did extremely well. If you see the numbers, during COVID, 2020-06 was the COVID lockdown, during which very few companies were allowed to operate. And as being essential services, Hindustan Lever products were available to all of us to go and purchase from the market. So the growth was from 1500, the profit went up, very good increase. From that level, from that base, the company has been showing, has still shown a 13,000, sales has gone to 13,000 crores. The profit is in the same range. It's not exceptional. Now, if you see the valuation is in the same range, it spiked because that it was operating and people were purchasing heavily, and the market cap is, the valuation is running in the same level thereabout. So it is a good growth, but it is not on that base. There is no growth available. There's no exceptional growth which is visible in this chart. Now, if you see the share price again, it is not showing. The data pattern is not strong. If you see, there is a strong fall, and that happened because there is an appreciation prior, thinking that the growth will come back, but it did not. So there is a fall. The data pattern actually reveals that fall very, very clearly. Now let's take a look at companies where it was positive. Now let's look at an Asahi Glass. So if you see Asahi Glass, the sales number is all time in the last many pieces, several quarters. It is 797, beaten all through without any this thing. No other quarter comes this thing. So if you see, the net profit is good. The EBITDA is very strong. Now, if you collectively look at it, this indicates that there is an exceptional profit which is getting reported. Now, why is this also important? Is if you take a TTM approach to it, if you see the scale is changing. What the company used to do about 150, 170 crores. Now, the last 4 quarters, if you add, it becomes 273. It's at a different scale, right? So the market price has started from the COVID low. If you see, it came back in 2021 to the same level prior to the COVID. Now it is seeing a better increase because of the strong performance which is getting reported. The data pattern is showing that there is an exceptional growth. If you just add the 4 data points over the next period, it will show that the growth is stronger than before. So that is visible. Now, in that, if you see the valuation, because of that, it came down to 34. It's in the same ballpark range, historic range. If you see the historic range, giving you a potential for an increase. So 34 times on the result date gives you an indication that if the growth is better, the PE can go up to historic levels. The range is available for growth. Now let's look at a few more companies. This is Nahar Spinning. Another beautiful data pattern. So the sales is all-time high again in the history. EBITDA is all-time high. The net profit is all-time high. It has been last 2-3 quarters. It has been like going up. The scale of operation is changing. So if somebody had spotted this in when in 2021-03, and that the growth was visible, and it was visible, the cotton textile industry having great demand from the US and Indian markets was visible around the March time. So from that time, the scale of the share prices moved up from 142 levels to 500 levels. Now, can it further go up? Now, if you look at it, the valuation is still compressed. Now, if we get visibility that this kind of 400 crores can be the sales, the market cap is just around 2000 crores. Unless there is a strong reversal of fortunes for the spinning industry, this data pattern will be indicative of a potential buy. Now, you have to constantly watch out if there is a damage to the margins or to the growth. But even if it does about 400 crores going forward, just adding the 4 quarters, this could be a very attractive proposition. Let's look at one more company, a company called Sport King. Okay. So once again, cotton industry, cotton spinning industry, exceptional sales growth, all-time high, exceptional net profit, exceptional EBITDA, around 2000 crore market cap. The price is also similar. Now, for this, the PE ratio is just 6.2. The ROE is very strong. If the outlook for this business is good, this data pattern is very, very attractive to look at. Okay. So having made this, now let's move to the next segment, which is the segment on how to use historic valuation multiples to spot investment opportunities. So we are going to take a few companies to demonstrate once again. So for every growth or margin environment, market assigns a valuation multiple. So every time a quarter result happens, the market gives you a valuation multiple. Now, if you save that and put it as for every quarter, it kind of reads like a story, which is what we are going to read. Past result date valuation multiples, which is price to earnings, price to book, price to sales, EV, EBITDA, and PG, are very, very useful indicators, particularly when you look at the change from last period to this period, or historic periods. If current growth versus valuation are better, what are we looking for? If the valuation is in the same range, but the growth spurts up, then even assuming no increase in the PE ratio, you will see the price will go up. So let's look at Maruti. So we go back to our data here. So if you look at Maruti, if you see the sales number, no beat. The numbers have been very, very weak. Profits have been very low. There's no real increase anywhere. The valuation multiple started to decline when its outlook was very negative coming after the COVID period. Now it's gone up in anticipation of better times in the future. It's quoting at around 7,600 rupees. It's been in the same range. Right? There is no increase in the profitability. In anticipation, it is at 2,30,000 crores kind of valuation, which it was about 2 years back. Now, unless there is a strong growth here, and there are many issues. We'll discuss that related to competitors, the EV industry, and so on and so forth. So unless we see a strong growth, this data pattern is not going to be attractive for investors. Traders, of course, it is possible if it drops to 7,000, it will go back to 7,500. But it is not a data pattern which will give you a strong, unidirectional upside, so to say. So let's look at Hero Motors. Okay, so Hero Motors, let's take the annual data, is much more revealing. So if you see the market capitalization of the company is 55,000 going up to 76,000, then 52,000. This is over the last 7-8 years. Now, why is it so? Because if you see, it made the profit of 2,500 crores, increased it to 3,600. Now it's back to 3,000. So effectively, there is hardly any growth, even though the current growth period looks good. Currently, due to base effect, there is a growth which is visible. But if you put it as a trend, the resume is not changing. And so the market capitalization is around the same, and price is very, very weak. Price is not growing anywhere. Its ROE has come down. What used to be 43% has come down to 18%. And slowly it is losing its PE multiple also, because there is no growth. Slowly, it is losing its PE number. Now, if you look at quarterly data, you see you see the same story. So if you see 25 times, 17 times, 18 times, 17 times. Now, if suddenly they launch a couple of brands and there is a strong YOY growth and the margin also expands, this stock will give you maximum bang for your investment. It will give you a very strong upside very quickly. It will potentially re-rate to a 3,500, 4,000 levels very quickly. Now, the numbers to watch is, of course, these growths, which should give you an evidence of a strong uptick in volume growth. We already discussed Asahi. Let's revisit that for a bit. So this was a company where there was a strong beat and the valuation had dropped, giving a potential upside. Potential space for upside is very, very clearly visible out here in the Asahi case, which we just discussed. So let's look at one more company where it did not work out. It's a Bansali Engineering Polymers. So a company where the margins are good, but it looks to be declining. Right now, the margins for 46% is slowly coming down, and so the valuation has dropped from 3,500 to 2,800. The growth is tapering, and because being a small company, being a chemical company, the risk is much higher. So the people are taking the money off this counter. In this particular case, let's look at the valuation. PE valuation looks nominal, but if you look at price to sales, it's on the higher side. If you look at historic price to sales, it has always been less than 1 time, but it is now quoting at 2 times. Price to book is fairly high. From that perspective, it's very high valuation. If there is a decline in margin, then investors are in trouble. So you should keep away from such stocks. So let's look at one more company. This is Laurus Labs, a darling of the investors for quite a while. You see the price from 87 rupees, it moved to 600 rupees. And then since that time, it has fallen over the last 1.5 quarters. And one of the key reasons for that is the drop in margin from 21 to 17. You can see from 33% to 29%. What used to be 297 crores of profit has come down to, has fallen by 1/3 to 200 crores per quarter. Now, if you look at it in a TTM context, it may not reveal the full story. But if you look at it from a quarterly standpoint, and if you analyze this to 204 by 4, so it indicates a fair amount of slowdown, which is visible for this company, which is why people have got out of this. So the historic valuation is slowly falling to 30 times what it is, and what it had gone up has coming down slowly. So let's look at market capitalization data as the next piece. So what are we saying in that? So how to use historic market capitalization data to find scale. Stock valuation is not just about valuation multiple, as we have seen time and again. A lot of big investors talk about in the stock market. Companies over time become much larger in terms of sales, in terms of profitability, and there is a multiple assigned to the then at that time what was the PE, what was the profit. Based on that, the multiple is assigned. So if a company was 100 crores profit and today it makes let's say 1,000 crore profit, obviously the market capitalization and the price will reflect that. So we are looking at which companies can potentially give a very large scale opportunity, and how do you discover that from the data. So first, let's look at the 10-year data for HDFC Bank and Shree Cement and how they have played out. It will give a kind of thought, and then we will go down to some of the opportunities, which how it is being thought through. So let's look at HDFC Bank. Okay, so if you look at HDFC Bank, it's been a winner for a long time. This is the 10-year data from 315 levels to 1500 over last 10 years. It has been not doing well for about a year now. We'll come to that separately, but that's the message is that there is a scale. And what is the scale? The profit from around 5,600 crores is gone to 33,500 crores. Now, this is called scale. Now, can you visualize when you're in 2012 or 13 or 14 that this company, because of its business model, can reach a large scale? And that large scale gets into a price, very good price. So HDFC is a classic example given by everyone. So it's worthwhile noting the scale playing out over 10 years. Now, let's look at one more company, Shree Cement, another darling of the investors over last 10 years. So if you see, the price has moved from 4,000 to 26,000 now. And why did it happen? From 700 crore profit to 2,600 crore profit. So this is scale in operation. This is classic scale in operation. Now, the valuation multiple, if you see, has been in the went up just prior to a rapid increase. The PE multiple will go up and then stabilize around these kinds of levels. Now, if there is a solid increase in growth in coming forward, this is a case, from 26,000, it can easily go back to 31, 3,200 if the next quarter results give clues for the rapid growth over the next 12 months. So we have to watch for that. The valuation seems to be getting into an attractive territory if the growth comes back. Okay, so but that's not scale. That's an immediate opportunity. The scale is, can this company over the next 10 years do very good numbers, maybe from 2,600 go to 10,000 crores, which if it should be possible for this company. And if that happens, then this is a great stock to as a long-term investment. Now let's look at certain other things which have done very well during very short periods. This is a company called Tanla Platforms. Now they are into a kind of blockchain product called Turblock, very rapidly done well. Now, if you see the price in just about 1.5 years, it has moved from around sub 100 to now 1,500 rupees. Now, sub 100 was about 1,000 crore market capitalization to 20,000 crore market capitalization. Now, at that time, it was doing very poor numbers. You can see anemic data historically, and now it is reporting very solid growth. Sales growth is north of 20, 25, 30, 40% growth. Profit after tax growth is very strong, and it has been doing over a very short period of time, indicating a product like Turblock, a blockchain product, has caught on. It is going viral as a product. And clearly, anybody who saw the potential in the product at 1,500 or 3,000 or 700 rupees would be sitting with a classic winner. This is a scale in play. Now let's look at a few more companies. So there is this company called Optimus Infracom. Now, in this company, you see there is hardly any change in the net profit or growth, but the price is increasing. Price is increased from 100 rupees to 300, 400 rupees. Now, why did this happen? For that, we need to look at what business is it into. Now, there's another company called Dixon. Dixon is today, let's look at Dixon. So Dixon is into a manufacture of electronic components for branded products. So it has a market cap today of 30,000 crores. Just about 2 years back, it had a market cap of just 3,500 crores. Right now, Optimus is also into a similar business. It has tied up with a leading Taiwan company. So in anticipation, people saw scale changing for this company from around from 200 levels of market capitalization, went to 800. The evidence started coming somewhere in between the March and June period, and in anticipation of the business which is going to come in the given the Atmanirbhar and government policies, so the price is already changing. So if you see anything which is secularly going, and you can study that by going into what the company is doing, is another form of data pattern. The company is still small. We saw Dixon at 40,000 crores. That if some of the business were to come to this company, then automatically the valuation, the scale will be very different. Of course, it would have been better to buy it at when it was 150 or 200 or 300 rupees. The earlier, the better. So you're basically looking at the price increase to understand what is happening, and soon the numbers will start reflecting what we saw for Dixon. So let's look at another company. This is Sasta Sundar, which recently was acquired. Part of the business was acquired by Flipkart. So once again, not much in terms of growth, but share price increase is tremendous. Now, this company is only about 1,500 crore market cap, right? But it is in the business of online pharmacy, online lab in a tier 2 context, where unlisted companies like Pharmeasy are getting very high valuations of, they're talking about $4-5 billion kind of valuations. Now, anybody who saw that Pharmeasy is getting valued like that is a new sunrise business. This share price increase is showing a data pattern which you could catch on to as a potential opportunity. Now, let's look at one more DMart. Okay, this is Avenue Supermarket, a darling of investors. Now, if you see, market capitalization has gone up by 4x from about 77,000 to this. Now, why did this happen? It's happened because of the sharp increase in net profit, and also that this sector, retail, India has a large population, growing middle class. So this sector should do well over long periods of time. This is very profitable, very well-run organization. The multiples continue to be very, very high. The scale is available, and people are willing to invest in this even now. The scale is clearly visible from that point, just to demonstrate the scale effect. Okay, so now let's look at to sum up in these three. All multibaggers have this common data pattern, which is rapid increase in sales, EBITDA, and PAT, and valuation rises as the data pattern accelerates. As we saw both these. Now let's look at a few more companies just to give a sense to this. Let's take a company called Acrisil. Okay, so here is a company called Acrisil. Okay. So you see the rapid increase from single-digit profit to 18 crore profit. Sales is rapidly increasing. If you go to the balance sheet, they're investing heavily. They make kitchen sinks in a specialized form of kitchen sink, which is finding very large user base in US. And with leading brands like IKEA, Grohe, and all that. So all that is reflecting in the opportunity. This is has been a multi-bagger, and if you see anybody who picked it around 200 levels, there's a good 4x which is visible in this. Let's look at another company called Intellect. We saw already Tanla, which reflected similar outlook. Okay. So here is once again, see rapid increase in net profits. A market cap has trebled because of has gone up almost 4x because of the rapid increase in the same data pattern is playing out quarter on quarter. One more company before we close on this issue, Lux Industries. So if you see the rapid increase in net profit, sales, EBITDA, which is reflected in the growth and the margins from 13% to 16%, ROE jumping, P ratio gradually market is rewarding more. So the valuation is jumping from around 1500 levels to 4,300 now. And last quarter results were also good. Now, if you look at Lux and Dollar and Page Industries, all of them have reported good numbers. So knitted, this segment is finding very good traction. People are sitting at home, probably consuming more inner products and so on. So that's getting being visible in the numbers. So let's look at a few companies we already discussed. Moving forward. Okay, so we may not have Q&A time, so let me skip a few things. Okay, so how to hold or sell using the same data pattern. So we saw two companies. We'll revisit that as Laurus and Bhansali. Okay, so here we are, Laurus. So very rapid increase in the data pattern was very, very strong till around 2021-03, and the next number came to be much lower. So as soon as this trend reverses, you need to start looking at why it is happening. Okay, 33%, 31%, 21 to 19. Now it's a time when you have to ask question. In the long term, over next 5 years, it may still do well, but there will be a correction if the earnings are weaker. So using the same data pattern, you can exit out of a portfolio which is not earning more and keep on looking for opportunities where you can invest very easily. Just one look of this table should be able to give you a sense of valuation, a sense of growth. Is there a rapid increase in growth or not? So here in this particular case, it's not clearly not the growth is tapering off. And if you look at historically, this is a company where suddenly it has become a 26,000 crore valuation. If it were to drop to 800, there will be a correction further in terms of net profit. If it, there will be a further correction. So let's look at Bhansali again. Right here also, there is the margins are tapering off the sector, chemical sector. There is more and more talk of cost pressures coming in. If you look at historically, it made 400 odd crores. It's come down from 184 to 164. So people are questioning. So as soon as you see the data change, it's important to evaluate very closely what is happening. Okay, so let's look at more next piece. How do you find an attractive industry? Now we have a simple solution for that in our by putting the data together in a particular way. So if you go and look at by industry, so let's say cotton, let's say textile. Okay, textile. Okay. If you see cotton textile, and all the data is available here, which is you can look at profit growth. If you look at any company, the last 3, 4, 5 quarters, the growth ratios, the growth percentage YOY is very strong across the board. Now you can look at for any industry here, and it will tell you a story what's happening. So you can look at the margin. They're all consistently going up for the relevant company. There'll be one or two which is not doing well, but consistently growing, right? Whether it is EBITDA growth, sales growth, everything will be visible. So our job is to find such industries where things are looking good, structurally positive, and in those find opportunities which from an attractive valuation and scale perspective, what are attractive. So I use this data to identify opportunities. So the other piece which is there is that this same trend is captured in this AlgoPix. We use some filters for the last about 8-9 years, which has thrown very good attractive investment opportunities. So this is as of 2020 September. So if you see, these were filtered out of using the same methodology which I just talked about. This is filtered out, and you see next 1 year returns have been 14%. All of these companies which shortlisted, these are above 50,000 crore market cap, very strong returns, which is for this set of companies over all historic periods. Using this methodology, what I've just described, the data pattern approach, the returns have been very phenomenal. Now, within these, if you are able to apply your mind into the future, in your return will be very, very solid, just like it has been for us. So you can look at any, this we publish whatever is coming through from the results, which are doing well based on this model of investing. So Page Industries has gone up after that. Brigade has run up quite a lot. Thermax has done quite well. Timken has done quite well. These are all recent algorithm picks. The same methodology which I am explaining is available here. And you can look at the industry whether everybody else is doing just a simple click, and you can watch all the EBITDA margin, PAT. So this is particularly useful for a budding investor to quickly understand what's happening. Okay. So let's take one more industry just to demonstrate that it does work. This is software consulting. Once again, if you see the PAT growth, very strong PAT growth in the last couple of years for most of the companies, right? So you will see, strong growth, PAT growth, which is visible. So now you can just click here, go to the company, look at the data pattern, and you're done, right? So let's move forward. So what are we doing? How do you get the story? We basically look at a company, look at the data pattern. If it makes sense and the valuation seems to be attractive, then if possible, do a computation just the way we did for forward PE using annualization. Then the third step is, first important thing is not to understand more about the company. See if there is any negative news about the sector. So if you see that, cost prices are increasing, some negative news is getting published, be very wary of that. So that means that there could be a potential change. Now, after you have established there is no negative news, like for example, cotton textile today, that doesn't have too many negative news. IT industry doesn't have too many negative news, right? Then the next question is, why should it do well? So there, if you start looking at analyst reports or articles written in the press about or by the company, or listen to the conference call, how the management is, how confident the management is, then along this whole process of step 1, 2, 3, 4 should lead you to overall get very good opportunities. It's a quick way of financial analysis, which is identifying very good companies, keep away from those companies which are not doing so well, and thereby profit from the opportunities. Okay, so so I'll just spend a few minutes how you can use just a minute. Okay. So Equity Levers Finance Lab is not only a data this thing. Let me do a quick walkthrough. So it provides articles, books in a data pattern approach to learn financial analysis. So any balance sheet, you have to read it like a resume over time, what you have done. Over time, if you start reading it as a resume, and how the market has given you as rewarded or not rewarded for your performance, gives a story. So if a company is doing well, but the market is not rewarding, there is some story to it. So you can learn more about those over there. There are investment games, which, so if you, okay. So these are, you can create your own investometer out here. Where this is Apollo Hospitals. You can download just by a login, and and you will get an Excel with all the information. You have to answer the questions based on, have you understood the data pattern? and accordingly taking the right call. So there are about 50 companies which are available here, which you can download and learn the skill of identifying the data pattern. So once you start identifying the data pattern, you can implement it yourself. If somebody tells you, some broker tells you that this company is good, so you can watch what is happening, why it is so. Okay, so for example, this will open out like this. Okay. 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 So, uh, uh, so there are questions which will be asked at the end of every data. So you can answer the question, and then immediately there will be immediately you will know whether it's materially good, it's wrong. So how you are observing, your skills will develop as you solve some of these investment games. Okay, so you can read this and solve it. The next piece is that the valuation data has been very, very useful for us to know whether there is an attractive a particular stock is attractive. The valuation data is not available in most of the websites, so we created it for our own need and for anybody else who wants to use. The algorithm ideas are a shortlist which I can start with. I can go to the shortlist and look at that closely, so that I can get a preconceived list which I can use. There's one more section which is available for finance enthusiasts. There are several finance projects which are available for people to practice real financial skills, build their financial skills, analysis skills, preparing financial statements, cash flow statements, ratio analysis with live data. So these can be practiced, and these are typically what an employer will look for: your practical skills, how you can do you know how to do a particular task yourself? These are all things which are available. So I think, Anvesha, I can take questions if anybody has any. Hello.
Sir, thank you so much for the insightful presentation. The forum is now open for questions. If you all have any questions, you can ask, sir. So meanwhile, there's one question on YouTube that has come up.
Okay.
Given the present pandemic conditions and the expectation of a post-COVID economic recovery, in your opinion, what will the market scenario be in the next quarter or next year?
Okay. So a lot of things are at play currently. So basically, there is the most important thing is the Federal Reserve is looking like it will start tapering. It will probably raise interest rates. So that's an overarching worry for investors. But beyond that, Indian demand seems to be still strong in many sectors. Textile is looking good. IT sector looks to be fairly decent. There is some spark visible in engineering companies like Thermax and all. So overall, there are many industries which are looking good. Lux Industries we spoke about, Asahi Glass in the construction space, real estate space is looking good. So the valuation has run up, and so I manage my portfolio by being close to the earnings. So whichever company is likely to report very good numbers is what you should be invested in. You should not look at some companies where it might do well after 12 months, or it will stabilize later. That kind of a feeling would cause you to lose money. Could cause you to lose money if there is a sudden sell-off. There is a sudden sell-off. Those are the companies where there is no earnings, might fall more and will not recover fast. So it is an attractive, even continues to be an attractive environment for investing. But with good circumspection.
So there's a question on cryptocurrency. What is your opinion on SEBI as a regulator of cryptocurrency in India?
I don't invest in cryptocurrency mainly because there is underlying asset is not there. At some point there will be regulation. Right now, most of the world is allowing cryptocurrencies mainly as a technology demonstration, and there are some investors who are willing to take a punt. And some point SEBI or Ministry of Finance will regulate, and it will also start operating like conventional financial instruments. Supernormal profits will not be there. That's my view.
Okay, sir, we'll take one more question. This will be the last question. Mr. Sarvesh Bandhu wants to ask, why is it that the Nifty Bank has not gone up even though the rest of the market has gone up?
In my view, it is very simple, and I can take a couple of examples actually. There is no growth. If you see, there is absolutely no real growth available. Let's look at one or two. It's a very good question which he has asked. Just a minute. If you see anyone, across the board, the bank. As soon as growth starts coming back, this also will start doing well. See, the growth, income growth is just 5%. Very, very meager top line growth. Now, you take company after bank after bank after bank, except maybe one or two. All of them have no growth. So they are adjusting for the write-offs are coming back and all sorts of plays on the numbers. But primarily, the credit growth for the banks have not come back. And the credit growth has not come back because so much money is being made by the corporate India and nobody's borrowing, or rather they are paying off whatever they took a loan on. There are multiple avenues for corporates to go today. The next capex cycle is yet to come through. So I guess that is the reason. And I'm a data pattern investor. So I closely watch the credit growth for every bank, every company. On the result date itself, I look at it in this resume style data pattern, and you can clearly see, there may be attractive valuation, but if the growth is not there, the market is very rarely will reward it.
Thank you so much, sir. Sir, first and foremost, thank you for accepting our invitation. And your webinar has been a very good and very insightful session. And we look forward to many more webinars like this from you, sir.
Thank you so much. Thank you, everyone. Please drop any additional questions in the YouTube link. You can reach out to me at just a minute. So just a minute. At badri@equitylevers.com for any questions. Thank you so much.
Thank you, sir. Thank you so much. And thank you to all our online viewers.